From New York City, for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, payrolls tumble and the unemployment rate rises as concerns mount over the U.S. labor market. And President Trump announces sweeping new tariff rates on global trading partners. All of the uncertainty driving volatility across markets, and stocks slide and bonds surge. But we begin with the big issue, warning signs in the labor market.
Job gains that have slowed down tremendously.
We're just kind of decelerating into a lower run rate of jobs.
There's certainly some stuff to be concerned about.
It is the takeaway from today's report, which is it's the revisions story.
This is a labor market that's shifting.
The labor market is okay now, but the risks are rising.
The second half of this year has a lot more headwinds than the first half did.
The interest-sensitive parts of the economy are under some pressure.
It's just a really complicated mix for the Fed to kind of deal with from here.
In September, there is going to be some sort of risk assessment.
When we get to September, it's going to be a much different ballgame.
And I think Powell's going to have to cut a little bit.
It makes a lot more sense to cut next year if the unemployment rate is stable.
We do think we'll see a cut in September and in December, and there's a possibility of more cuts next year.
We're in sort of uncharted territories, and when you're in uncharted territories, you want to be very cautious. And I think that's what the Fed is being at this point.
Now, I want to give you a look at the two-year yield over the course of this week. Shorter-term rates were just fluctuating so much, went on a real ride, as you can see, first higher because of what traders perceived as a more hawkish, generally more hawkish message from the Federal Reserve. It stayed higher yet as we saw inflation data come in a little higher than expected, and then a big drop off after labor market data that now has traders betting more and more on interest rate cuts into the second half of the year. You could see on Friday you had more than 20 basis points of a drop alone in the 2-year, and steep moves in the long end of the curve too. But let's flip up the board and look at those expectations for a rate cut and how drastically they've been changing. Fed rate cut bets for September have reached close to 90% of a chance. Very different from just a day ago when those odds were closer to 45% prior to that jobs data. It's 2 rate cuts priced in through the course of this year. And you even have people like Rick Reeder saying that you could see a 50 basis point cut. Let's see how that data plays out. But speaking of the Fed, Cleveland Fed President Beth Hammack joined Bloomberg Television earlier today. She spoke to how pivotal this environment is in the economy for policymakers.
This is a really tricky time for monetary policymakers. This is when both sides of our mandate could potentially be in conflict, and we'll really have to look at what is the size of the mess and for how long do we think that is going to persist. And so, again, it will take a lot of conversations with businesses, with community leaders. It'll take a lot of careful analysis of the data, and it makes sense that there can be disagreement at these particular moments because this is really the most challenging time for monetary policy.
Joining us now, Russ Brownback, co-portfolio manager of the BlackRock Strategic Income Opportunities Fund, and Ira Jersey of Bloomberg Intelligence. And first, Russ, I want to have you speak to what you had Beth Hammack talking about over at the Cleveland Fed, this idea that you could potentially see the dual mandate in conflict. Today, clearly the bond market is betting on rate cuts, but I want to remind everyone that we were just recently talking about that inflation miss. Which concerns you more?
So, listen, we think the economy structurally is very, very sound today. We think on our team just that the policy setting today is a bit suboptimal. You think about the last time the Fed hiked rates in July of 2023 to 5 3/8. The real policy rate then was only 100 basis points. Today, with a lower velocity economy, it's about 150 basis points. And so it's this notion that where rates are today are hurting disproportionately the lower income parts of the household sector. At a time when velocity in the housing market and in the labor market are slowing demonstrably. So we think this evidence today will give more impetus to the doves on the committee in terms of their endeavor to cut rates in September.
Now, Ira, I want to point out something that you had pointed out a little bit earlier, that you said that the market will quickly put a September cut back on the table, and boy have they. But you also said the knee-jerk bull steepening looks completely justified. Explain the long end of the curve in relation to the short end as the market navigates some pretty complicated cross-currents in the macro and in the policy that you're seeing put forward by Washington.
So one of the reasons I think we're going to continue to see bull steepening as the economy slows and the Federal Reserve ultimately cuts rates, whether that starts in September or October, that doesn't kind of really matter for twos and longer, in my view. The big thing is that, one, people are going to worry that the Fed is cutting, and that's going to either spur inflation or growth, and you wind up with a V-shaped recovery if we do have a slowdown, and that means that you have higher rates at some point in 2027 or 2028, even if the Fed cuts 100 or 150 basis points over the next year or so. So that's number one. And number two is the continued fiscal situation, where even though the Treasury Department said, hey, we're not going to issue more 10-year notes, and they said that just this past week, instead, we're going to just issue T-bills. But eventually that's going to have to change, whether it's President Trump who does it and his administration or the next administration. At some point, you're going to have to start issuing more longer-term debt. And that is something that's weighing on some investors' minds. Yeah, definitely a lot to unpack there. But first, on the long end, really interested in hearing your view on this, Russ. Do you think that if you brought down shorter end rates, that the long end would drop in synchrony? There's a lot of doubt here that cutting rates will change the trajectory. The term premium demanded for the 10-year, how do you feel about it?
Yep. So listen, I think the front end of the curve is anchored to Fed policy. The long end sort of gravitates toward where nominal GDP growth is going to go. So we find it to be in equilibrium today. So if the curve steepens, listen, we live in a world where there's too much money, not enough yielding assets. And so investors will find the value on the curve. And, as you steepen the curve out, the power of roll down for a steep curve gives more impetus, again, for investors to make that extension out the curve. So, and by the way, the yield curve is normally steep. So it's really just finding what, if you look back over history, is a very normal stance, suggesting that things are, that policy is going to get to the right place and that the economy is going to soft land and be just fine.
Where does that leave you, Ira, with where neutral is ultimately? It's been an interesting week where that number seems to be a very nebulous one that no one really wants to talk about. I mean, what's your best estimate?
Well, the problem with your neutral rate is you don't know it until you're already there, right? And that's one of the big challenges here is we don't know structurally if things have changed significantly. So when you look back at all the models for R star and this magical neutral rate that the Federal Reserve is always trying to get to, nobody knows. And I suspect that it's actually much higher than people might think, in large part because the structure of debt of the household sector and the business sector has shifted quite a lot over the last 30 years, where there's a lot less short-term debt being used to finance everyday operations and purchases versus longer-term debt, and because of that, I suspected that you can actually have higher interest rates and still have a reasonably robust economy. Now that being said, that doesn't mean that we shouldn't have lower interest rates now, especially when you get data like we did. And in particular, in today's data, I was looking at a lot of the wage data, and some of the wage data was a little bit concerning, right? When you have slowing services wages, that does suggest that maybe you're going to start with having a real slowdown in consumption and the economy overall. And if that's the case, and that does happen, then that really justifies lower interest rates. Even if we don't have a formal recession, you should still be lowering interest rates into that type of low wage environment.
Well, the problem with not knowing where neutral is not knowing how far you are from it. Russ, how do you think that this will play into the direction of rate cuts heading into next year? Certainly, if you believe what Ira believes, that you could actually see hikes coming in to the following year.
Yep. So I know you were hoping we were going to disagree on some things, but no, we actually agree. I think Ira described it perfectly. The economy is structurally very sound today. It's just going through a moment where velocity is dampened, owing to all the policy uncertainty. And so, that happened in 2023. It happened in 2024. If you think about the dynamism and the structural underpinnings of the economy, low velocity in terms of hiring, but no job destruction. So the labor market is pretty solid. It's a services economy, which doesn't realize volatility over time. And then you've got this incredible CapEx cycle today. Look at what the hyperscalers did and announced over the last couple of days. It's very, very powerful today. And now you have a very stimulative fiscal package with the items that will be catalyzing CapEx front-loaded. So you put all that together at a time that the Fed's bringing rates down. It's actually a really powerful setup. So I agree with the way Ira characterized it. We're not going to be back to where a neutral policy rate was in the pre-pandemic decade, but it's a pretty darn good setup today.
It's interesting. Ira, you kind of hinted at this a little earlier, the technicals and how that might drive bond market behavior in the future. Given the inability, at least in the near term, for the Treasury Secretary to term out that debt issuance, how is the issuance cycle going to dovetail with bond demand?
Yeah, that's an interesting question. Actually, Russ has a pretty interesting take on this, so you should definitely ask him this question.
I asked the wrong person.
Well, I think with the supply side, however, it's a matter of if not when you're going to get more long-term supply, and we've been talking about the liability-driven investors for quite a long time, needing and wanting that 5-ish% yield on 30-year debt. And as we've gotten there the last 3 times, you've seen insurance companies, some pension funds, kind of wave in 30-year debt just because it fits certain mandates and profiles without having to go up, down the risk curve. So you don't have to buy BBB corporates when your 30-year bond is at 5%.
Interesting. Russ, I will let you weigh in on this one. I want to see your take, but also what it means in terms of investors who are looking at credit spreads saying they're way too tight, and maybe duration in the Treasury market can be something we could take on right now.
Yeah, I think that the technicals are completely underappreciated in terms of how powerful they are. We live in a world with too much money, not enough yielding assets. There's $25 trillion of cash on the balance sheet of the private sector today. That's more than all marketable Treasury debt that's outstanding. There's $218 trillion of private sector net worth. The aggregate index as a proxy for high-quality bonds in the United States is only around $29 trillion. And there's about $3 trillion that markets spin out in terms of income, stock buybacks, dividends, that needs to get reinvested every year. So this is a transcendent influence, and I think people underestimate it.
We thank you so much for joining us today. A lot to think about, a lot of numbers to digest, which I very much appreciate. That is Russ Brownback of BlackRock and Bloomberg's Ira Jersey. And up next, we have the auction block. We're going to talk about credit, public and private, as monthly issuance for junk bonds tops $30 billion. Again, the rush just doesn't stop. Stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we look at credit issuance for the week and for the month. U.S. high-grade weekly volume of $12 billion was led by sales from foreign banks, RBC, Deutsche Bank, and UBS, which saw it sell more than 11 times covered. July volume, though, was $81 billion, coming in way below estimates, marking the lightest month for supply this year. In U.S. high yield, July volumes topping more than $35 billion, which is the second busiest month since September of 2021, making it the third straight month of more than $30 billion in issuance and the busiest since July since at least 2006. July also set a monthly record for leveraged loan launches, reaching over $222 billion, and that marks the fourth time in 14 months an all-time record has been broken. Records are starting to get boring. They're coming so hot and fast. And when it comes to alternatives, we spoke earlier to Ares CEO Mike Arrighetti, who says that even with the market volatility today, he's still looking for some strength.
When we look at our portfolios around the globe, the fundamental performance is still really strong. There's a lot of liquidity in the markets. There is a lot of pent-up demand to transact. We saw that in June, I think, once we got the tax bill done and we saw some certainty on tariffs, the market really picked up. So I don't want to say that one headline on one day is going to knock us off course.
Joining us now, Dan Zwirn, co-founder, CEO, and CIO of multi-strategy investment firm Arena Investors. And I do think that the comments he made were interesting because they weren't in particularly only around the M&A heavy direct lending stuff that we typically talk about with private credit. It seems like a lot of people are diversifying away. He spoke a lot this morning about infrastructure, real estate, other things besides lending to deals. So it makes the question for me around how risky are these deals that are coming to market pretty relevant. These are pretty levered companies, aren't they?
They are, and I think one of the reasons, for instance, you might think about real estate versus corporate is that real estate showed really the problems associated with the asset bubble that was punctured in late 21 sooner than leverage finance did, right? So in a lot of situations, real estate's kind of come back to earth in many instances from a valuation perspective, whereas corporate's been more masked by the extend and pretend and liability management exercises that have been out there. And so that's affecting some of this new issuance.
What does that mean for this leveraged loan market as well? Right now you have leveraged loans in direct competition with private credit. As the deal market does come back, is it healthy?
Well, we would argue that it's pretty generous. You know, there's a reason why everybody wants to issue, right? It's when they think that issuance is a pretty cheap thing to do. And furthermore, I think there's not necessarily a well understood direct connection between middle market private equity, direct lending, leverage lending, and CLOs. And so there's still a lot of CLO buying power out there. A lot of people still want to do CLO equity. And so that means that the bid for those new leverage loans is very, very high and very, very aggressive. And you're seeing very high levels of leverage and very low levels of covenants.
I was really struck this week by a story by my colleagues around Vista Equity in particular. This idea that they're saving over $200 million by ditching the private debt industry, refinancing by going back to syndicated loan markets. What are the implications of that? They're one of the bigger borrowers out there. How many others are out there doing the same?
Well, I think a lot will be. Now that you have, given the size that direct lenders in the sponsored markets have gotten to, and the tremendous bid from the leveraged lending market fueled by CLOs, they've really become substitutes for each other. And so at any given time, one of them may be cheaper than the other, and you'll see sponsors going from back and forth from one to the other. What's
your best advice for investors out there right now that's looking at supply, come back to market, and saying, okay, buy this, avoid that? What is out there that should be avoided right now?
Well, I think we'd be oriented toward a little bit of a liquidity barbell, if you will. As a general matter, in things that are easily accessible and tradable across the corporate fixed income markets, both in investment grade and high yield and even in structured products, we're going to be staying more senior, shorter, more conservative, and at the same time really putting our risk budget toward less liquid things that require direct origination and frankly require more work to get on. And so that's where you're going to see that excess return.
I also want to point out, just more broadly, you had Goldman's chief strategist here in their credit book here saying that complacency is really at its worst levels since 2007. They're really worried about where people have dived into and how much risk they're taking on. How do you feel about just the level of complacency that is in the market right now? And, you know, what would really cause that to reverse?
I think it's really high. And what you're seeing is that never before since the GFC have we seen the ability of the market to innovate around the thwarting of price discovery. And so when you see real value diminution, you don't see the trading, you don't see the marks because, for instance, with insurers and banks, they don't necessarily have to mark to market when they haven't actually sold a bond. And so there's a lot of these different methods that people have gotten confident about, saying, well, even if I have a problem, I won't really have a problem because it won't show up for a few more years.
Kicking the can down the road. It's a story we've been hearing for a while. Now, a little more from that Goldman view. I'm reading from their note that they say there are enough sources of downside risks to warrant keeping some hedges on the portfolio. Growth could surprise further to the downside. One, do you agree? And B, what are the appropriate hedges right now?
Well, I think it's more really a relative value evaluation, right? So where am I most exposed to kind of macroeconomic risk? Where are margins going to compress? So that's going to mean probably lightening up relatively in corporate and moving toward things in structured finance and real estate, trying to be higher up in the capital structure. If you want to truly hedge, you know, I'd love you to tell me what the answer is, because we look for those types of hedges all the time, and they are kind of grossly overpriced because it's not a mystery that there needs to be hedges out there. And so those people in the business of selling volatility effectively are able to do that very profitably because those hedges frequently don't work.
So what do you think that cash serves as right now? Is it an appropriate hedge if for no other reason than it keeps your powder dry?
Well, I think another way to theoretically keep your powder dry is keep your duration tight, right? So you constantly have interest and principal coming at you so that you can redeploy at will versus necessarily just having a big bunch of cash that's depreciating every day as the current administration extends the former administration's policy around kind of fiscal indiscipline.
So what do you think the biggest risk that's underappreciated out there is today? If you're looking at the macro flying at you right now, what do you think investors are not baking in?
I think a lot of investors don't really understand the underlying structural leverage of the things in which they're investing. So certain things sound very safe, like a collateralized loan obligation. You hear the word loan, except that you're 10 times levered. Or situations where, as an example, you see CRT, credit risk transfer, where people kind of perceive themselves as taking a part of a big pool of loans, but when actually they're at a very junior part in the capital structure that's very risky. So there's a lot of terms of art around, maybe smoothing over the perception of risk on the part of investors.
It's the three-letter words to look out for, and all the fine-tooth details. Arena Investor CEO Dan Zwirn. And if you can't get enough talk on credit like me, please check out the Bloomberg Credit Edge weekly podcast on the terminal and wherever you get the podcast. And for me, I like it because you can meet some more members of the industry. It gets pretty interesting, and there's a lot of debate to be had. Now, still ahead, we have the final spread. The week ahead, earnings season rolls on with major companies reporting from around the globe, plus comments from Fed officials reacting to all that data that we got in the last 24 hours. Stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread. Coming up, we have Berkshire earnings over the weekend and Monday, U.S. durable goods data. Tuesday, EV earnings from Lucid and Rivian. Wednesday, earnings from Disney, Novo Nordisk. And Thursday, a Bank of England rate decision, plus more Fed speak. Friday, Vice President J.D. Vance visits the U.K. And for my final thought, I want to take a little closer look at today's payrolls print broken down by sector, because jobs in professional services, manufacturing, and government saw the biggest losses in July, which might not surprise you too much when you saw that ISM data come in below expectations this morning as well. The job gains coming in finance plus transportation and utilities. So keeping a close look on exactly where those job losses are coming from as we head into September, where investors are expecting a rate cut. Now from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.